Welcome to Financial Flipside. In this video, the topic of discussion is SoFi Technologies and their SoFi stock. In the first article, we will analyze and discuss how Cathie Wood of Ark Investment recently purchased $1.2 million worth of SoFi shares despite a recent downgrade from reputable organizations like Morgan Stanley. Then, using an article titled "Time to Bet Big on SoFi Stock, the Stunning Turnaround and Why You Should Join the Rally," we'll examine whether or not investors should buy before the earnings report or sell before the earnings release. So, the main point of this post will be to persuade you to purchase SoFi stock before the results report. And in another post, I'll try to persuade you that SoFi stock price will actually fall after they release their earnings. We'll thus weigh all sides of this. But as I stand to gain from either outcome, it makes little difference to me which one occurs. And when we come to those articles, I'll go into more detail about my method. Let's get right to the stories for today. So, as I mentioned in the introduction, Cathie Wood of Ark Invest is a well-known investment star. That's a different narrative, depending on whether you like her or not. However, it demonstrates that Cathie Wood spent $1.2 million to purchase SoFi stock. She recently added 133,191 shares to the ARKF ticker for the fintech innovation ETF from Ark. She thinks this company has absolutely incredible long-term potential because they accomplished all of this for a cost of about $9.09. And this is despite a Morgan Stanley analyst downgrading SoFi Technologies' overall rating. SoFi stock is currently trading for about $9 per share. On one end, there are bearish analysts who think it might drop to approximately $3 per share, while on the other, there are extremely positive analysts who think the company's entire stock price, appreciation, and momentum are just getting started, and that it could soar up to $14 per share. Numerous significant institutions and well-known traders have cut their positions in SoFi shares or taken profits. I do not, however, advise selling all of your SoFi stock. Actually, I would encourage holding these shares because I believe that investors should actually be concentrating on the company's long-term fundamentals, which are entirely unaffected. Therefore, even if the price of the company rises or falls, I believe that investors are overreacting. And we as wise investors want to prevent overreactions or emotional reactions to the market as a whole. We wish to conduct our investigation, maintain our premise unless anything radically changes, and keep a small position in SoFi stock. However, this author advises purchasing SoFi stock because, as he will explain, he thinks it will continue to gain momentum. He makes reference to the first quarter's adjusted revenues, which increased by a very outstanding 43% year-over-year to $472 million. The fact that they have a diverse business strategy with 3 key business divisions, which fortifies them and makes them extremely resilient and steady despite any macroeconomic instability, is, in my opinion, what makes them more outstanding. Additionally, following their first quarter results, management raised their full-year guidance for their adjusted net revenue and adjusted EBITDA, indicating that they expect to earn around $2 billion in total in 2023. This represents a CAGR, or compound annual growth rate, of 30%, indicating that the business is expanding quickly. However, for their second quarter results, they might see a 32 to 35% increase in adjusted EBITDA, which could total between $60 and $70 million. This is really encouraging news. And according to the author, this will result in a spike in the company's stock price, which will cause it to rise. As a result, management was able to raise their overall forecast for quarter 2 as a result of SoFi's generally favorable first quarter results. In addition to having a well-known business strategy and a wide range of revenue sources, SoFi positions itself as a particularly alluring long-term investment opportunity. That is an example of a company stock rising after earnings. Let's wait and see what the following author, who is generally more of a bearish critic, has to say. However, I believe that he is still optimistic about SoFi Technologies in the long run, and you'll understand why in a second. He claims, while earnings releases can sometimes lead to a big post-earnings rally, there's also equal concern because, he says, many stocks actually experience a post-earnings price decline despite prior momentum. So, does that imply that now is a good time to sell your shares in the business? Absolutely not. That would be bad risk management, since, as I said, I think keeping the firm through earnings will be your best option, as the company's share price might even rise initially before dropping later. And to be completely honest, I believe that will most likely occur. But overall, I believe SoFi Technologies will outperform the market heading into their earnings report, particularly in terms of revenues and earnings per share. For this reason, the author reiterates that you shouldn't sell your shares either before or after the earnings report, because this is a long-term investment. It is because the long-term bull case remains unchanged, regardless of what happens in the short term. Now, if the price does truly decrease, this could present a chance for newer investors to seize a fantastic buying opportunity. However, even if the price rises, by just investing a small amount of money into this company on a daily, weekly, or even bi-weekly basis, your average cost basis will level off, and you will be guaranteed a respectable average cost. Consequently, you are essentially certain to profit over the long term. There is a silver lining in this situation, since it makes sense to sell the stock given the likelihood of a post-earnings plunge, which would indicate that when the earnings report is released, possibly a day or two later, we might potentially see the SoFi stock actually downtrend before uptrending over the long term. The question is, why not sell it? Again, the firm's long-term bullish case scenario, which is honestly what I am focusing on as a long-term investor, is unaffected in any way by short-term volatility or short-term news. He reiterates, what I truly appreciate about SoFi is that it is snatching up the slack left by big, massive, out-of-date banks that are ignoring young high earners, which are not served well. Instead, you would want to place your long-term bets on a financial institution that is relevant to the digital age and attracts young people with high incomes, since these people could end up being the next generation of CEOs. You should also be aware that, based on recent financial estimates, SoFi is already close to becoming profitable. In my opinion, this will further increase their momentum moving into the year's conclusion. Again, their long-term possibilities are really amazing, in addition to their highly intriguing short-term potential. Therefore, the wisest course of action would be to just hold your position both before and after earnings. Try not to guess what will happen in this situation. Sincerely, just concentrate on obtaining a reasonable cost for this organization while avoiding overexposing oneself, as that could mean that you are assuming an unneeded and significant chance of loss. And I personally support no more than a 5% initial portfolio allocation, as I believe anything above is poor risk management. And by using this general principle, I've been able to both minimize losses and take advantage of profits. Because even if you have a 5% allocation to 2 SoFi Technologies in your portfolio, and the price drops after earnings, that 5% may drop to just 4% or 3%, and you could take advantage of this opportunity to invest again in the business, lowering your average cost basis to raise that back to 5%. Furthermore, if it is greater than 5%, you may essentially leave it ride. The 5% is only an initial investment. It is obvious that if an investment grows over the long term, you don't necessarily need to cut it or extract profits. You can simply let it grow. Overall, I would advise against timing the release of the next earnings report because the company's long-term fundamentals remain terrific and outstanding and are still fully intact. Additionally, they have a B rating on Portfolio Grader, and I believe SoFi Technologies will achieve big things in the future, which is why I report on it and why I personally own and purchase it. In light of that, please share your thoughts regarding SoFi in the section below. Thank you for watching. Don't forget to like and share this video. To be more knowledgeable about financial topics, make sure to subscribe to Financial Flipside and hit the notification bell to get alerted when new videos are posted.